Good morning, traders. Welcome to the Flow Show. Hope you've had a great weekend and wish you, as always, a great week ahead. I'm on my trot again for a few more days. Kay and Stel both off, and so just me, myself, and I again to keep you company as well as you guys. So keep your comments coming in the chat function. Please let me know what you want to talk about. Save me waffling on my own stuff. Let's kick right into it, get the show on the road. China left their 1 year medium term lending facility unchanged at 2.65% as largely expected. I'm not willing to get into any further cuts just yet. There was a ton of data out from China as well. GDP coming in a bit softer. I haven't actually got it up, so give me 1 second. Let's get that up for you. Monday mornings. I hate Monday mornings. Never get myself on straight on a Monday. Where are we? There we go. And voila. Let's get that in there. So coming over to Chinese data, as you can see there, GDP coming in softer than expected, up on last quarter. Year-on-year basis 6.3, but missing expectations of 7.3 year-on-year. What that has done is got a few people drawing down expectations from German growth, well, mainly bank forecasts, which, as you all know, aren't worth the paper they're written on. So that GDP number there coming in 0.8% quarter on quarter. These are the first numbers for Q2 that we've had pretty much anywhere in the globe. Only just closed off the quarter really, but quarter on quarter beating expectations, but still less than the 2.2% previously. Year to date was a bit of an improvement, 5.5% from 4.5% prior. Industrial production, that data was looking not too bad, coming in 4.4, good beat of expectations. Year on year, also an uplift over last month. Retail sales coming in a touch softer year to date, there or thereabouts on year, bit lower than expected, but you can see that big drop there from 12.7 to 3.1%, but still a gain, so still improving there, but not as hot as anyone would like, particularly the Chinese. As I say, lots of growth forecasts being cut, particularly this morning. JP Morgan cut their China growth from 5% to 5.5%. Sorry, from 5.5% to 5%. They're cutting GDP growth for 2023. Citigroup cut it the same, 5.5 to 5%. SocGen the same, 5.5 to 5%. Morgan Stanley cut from 5.7 to 5%, and UOB cut from 5.6% to 5%. So they're all lined up at the 5% mark now, but as usual, bank forecasts really getting it wrong once again. I'd like to see a bank forecast actually get something right for once. But anyway, I digress. China's National Bureau of Statistics spokesman, Fu Lingwei, was speaking at a press conference after all that data, said that China's economy is likely to continue improving. China is fully confident that it is capable to achieve its full-year GDP target. China's economy won't face deflation in the future. Now, lots of things are said about Chinese data and their ability to massage a number, so to speak. So I wouldn't be surprised if they did hit their GDP targets, and thus proving the banks wrong once again. Anyway, in other news, China's first half 2023 crude oil production was at the highest since 2015, says the Stats Bureau. That might be one of the reasons why we're just seeing a little bit of pressure coming into oil. There's been some other news as well about the Saudis extending their production levels out further, so not willing to cut back too much just yet. We are seeing a little bit, as mentioned, a pullback in oil this morning, but then I didn't really understand much of the rally in the first place. But as you can see, a bit of news tinkering around there on the Saudi headlines that just dropped not so long ago. Coming over to some of the other data, and well, not data actually, over to Japan and Goldman Sachs saying that any drop in Japanese stocks on a potential BOJ YCC tweak would be a strong buying opportunity. Japan still very quiet, especially from BOJ members. We do have ministers and whatnot around the G meetings issuing the odd comment, but the Bank of Japan still firmly zipped up. So not hearing anything from those, and still not quashing the rumours that the Bank of Japan may tweak in July. As I've mentioned last week, I don't know if that's going to be a signal that they're going to do something, the fact that they're not stamping down on any of these rumours, but it does remain a risk right up until the meeting. Over to Europe and more forecast changes. The Bank of Italy has revised its 2023 GDP forecast upwards and lowered 2024 and 2025. 2023, it's been hiked to 1.3% from 0.6. 2024 is down 2 pips to 1.0%, and 2025 is also down 2 pips from 1.3 to 1.1%. They're blaming the effects of worsening financial conditions, which has been brought around by rate hikes, obviously. So starting to play the blame game in some countries regarding rate hikes. ECB is apparently going to peak at 4% in September, according to a bunch of economists speaking to Bloomberg. What we have seen last week is a bit of a drawdown in rate expectations, namely started from the Fed, based on the data we got last week, CPI and whatnot. A lot of rate expectations coming down. Pretty much a second Fed hike has been washed out, and even some pricing of cuts for mid-2024. And that's had a knock-on effect to the BOE and the ECB. So economists now thinking that they will peak at 4% for the ECB in September. There was an interesting piece out in the press over the weekend saying that people in Spain and countries like Portugal apparently raiding their savings to pay off mortgages, which is completely opposite to what countries like Germany are doing. The reason for this is that mortgage rates in countries like Spain and Portugal are more of a floating variety or variable rate, i.e. they move in line with ECB rates. So obviously there's been a big uptick in mortgage rates over there, and that's seeing people jumping into their savings to pay down mortgages, so in case rates go even higher. Germany, it's the opposite, because there's more long-term deals done there. For example, 10-year fixed rates are pretty popular over there. So while a lot of Germans may have locked in at lower rates, you know, down around the 1% mark, even less, they're now getting 2.5–3% on their savings. So they can actually offset a lot of their mortgage costs with savings in the bank, off, you know, earning maybe twice as much interest. So they're not so fast to pay down mortgages, but this is something that will come into significance when all those deals roll over. Obviously, not everyone's on a 10-year deal that have 10 years from now. Some people might be 5 years into a deal, 7 years into a deal, that sort of thing. It's a similar picture for the UK, where a lot of people are expecting a bit of a mortgage blow up in the next year or so, as a lot of 2-year fixed rates come to an end from lower levels. Again, sort of 1–2%. Now they'll be jumping into 6–7%. So it is something that needs to be kept an eye on for the future. Looking back at the US data last week, bit quiet on Friday. Obviously, did get some further price data, which you can put in the inflationary pot. Import and export prices all showing a negative, all more negative than expected. Pretty much all more negative than they were previously. As you can see there, year-on-year numbers, particularly export prices down 12%, worse than 11.1 expected and 10.1 prior. Import prices the same, worse than expected, down 6.1%. So further signs, as mentioned, that inflationary or disinflationary pressures are well entrenched now into US prices. That's all going to feed through to further inflation reports. Bit of a surprise and a bit of a soft landing data to add to the mix in the US. Michigan consumer sentiment, an absolute rocket, 72.6, absolutely smashing what was expected at 65.5 and the previous 64.4. Pretty much all the metrics were much higher, current conditions, expectations, even inflation was higher, which is a little bit of a worry for the Fed. 1 year inflation expectations jumping to 3.4% was expected to stay unchanged. 5 year inflation came in as expected, up 3.1%. So a little bit of a tick up in the consumer expectations for inflation. Obviously, these can be a bit more volatile in terms of comparing to the actual numbers. You know, consumers can be swayed very easily by prices in shops, fuel, that sort of thing. So quick changes they see there can get reflected in this survey. Not a big survey overall. It's a survey run on about 500 people via telephone calls. So it's not a huge catchment, if you like, of the US population. But on Friday, lack of other data, lots going on in the market, a bit of volatility in the market, and we saw further big moves here. Now, what that did potentially what it did do in prices was take up dollar yen up through 139. This was an area that I was looking at, bit of a zone looking at on the way down that didn't really do anything. It held up for about 5 minutes before the break. But I was very interested in what happened up here at 139 when we saw this big bounce Friday morning through Europe after seeing this low in Asia. Got up there, it held. That keeps the pressure on at the moment for this trend that we've seen. This is where sellers have parked the bus and said, okay, you want to do something, buyers, you've got to kick us out through here. What this means going forward is we've got a bit of a level now down here, a bit of support. I still think this was a bit of an excessive blowout, this move on Friday during Asia. The reason being we got a really strong bounce afterwards. That's always a sign of a potential overextension of a move, but we couldn't take out the 139 area, so the trend isn't broken just yet. So I think we've got a bit of a range setting up. I'm expecting 138 to be significant again on the way down. If you start to see that becoming support again, then we've got a bit of a battle. 139s, 138s, see what happens there. If we do get a blowout again under 138, this low down into the 137s, which is also a bit of a technical, is also, oh, excuse me, let's shut that up. So yeah, down here in the 137s, low 137s is going to be significant if we get a move under 138. We might set up a bit of a range, 137, 139. That gives you short-term scalpers, something to trade in between the goalposts, but I will be watching very carefully for a break. If we get a break above 139, the sellers already shown that's where they want to step in again. A break above there is going to put those sellers at risk. All the sellers who are stamping on it all the way down, get above there. Those are the sort of areas you break and it causes a few maybe weak hands to throw in a towel. Then you get a bigger push up. Maybe we get up to 140s, 141s, that sort of area. If we don't get through here, it does keep the downside pressure on. If we get a break of 137, even if we make a new low that's just a few pips under this one, that keeps the sellers with the upper hand, and maybe we are continuing to head lower. We'll look at what's coming up on the data front in a bit, but as I say, I'm keeping very carefully at the back of my mind that we're not hearing anything from the BOJ. I may be overthinking it, but you know, silence can tell its own story. Right, coming back to the bits and pieces, and in stocks, it was the start of earnings season on Friday, and some of the big banks, a lot of the big banks coming out, and pretty much all of them beat. JPM beat, BlackRock beat, Wells Fargo beat, Citi beat. So no worries again for what's going on in equities, at least, or at least on the ground. So decent numbers there, keeping stocks well supportive, not seeing any problems there. What it is causing, particularly the stock rally, in particular things like the S&P, is a few day traders who are a big chunk of players in US equities. They're getting a bit of FOMO, and as such, they're now piling, or have been piling, into option trades, namely call trades, which is the right but not the obligation to buy the underlying asset. So they're jumping into call trades thinking that the market may be going higher. That sentiment is maybe a bit cautious why they're using options and not piling it into cash, but it does smell a bit of FOMO. The reason for that is that on last Thursday, a record 1.8 million S&P calls traded. About 2/3 of that was in very short dated contracts. So you're looking at a few weeks to maybe just a month. Now, several things with this. As I say, it shows caution that people are not wanting to pile into cash, i.e. buying stocks at the top. A call option, their risk is limited to the premium only. Now, on the other side, we don't want to find out that to pay for those calls, they're selling puts, because that's a double whammy. It means they will potentially lose money on their premium on the call trades, but it gives them an unlimited long lower down. If they're selling puts and the market dumps, they're effectively long, and the price is well out at the money. So as long as they're not selling puts to pay for the calls, then it's a low risk trade. But it's also a bit of a self-fulfilling prophecy, if you like, because if they're buying calls, whoever's selling them calls is then going to hedge in the market by buying stocks. So that's going to give them the rally that the call holders are looking for. So it's a bit of a, to say, bit of an infinity loop, a self-fulfilling prophecy, if there's a great deal of hedging. And obviously, banks and the like who are selling these options can go and hedge via other options elsewhere. So it's not a linear trade, so to speak. But it does have an effect of keeping markets supported when a lot of calls are traded. As for stocks, or rather US assets, Morgan Stanley was out saying that that people should buy any dip in bonds and exit dollar longs. They're seeing a top in the dollar and also a potential top in yields. This is something we were speaking about again last week when looking at yields. You know, what was this move that we got in a lot of bond yields, particularly US, you know, ticking into 4% up to 4.9%, and why did it suddenly crap out? It still feels to me that what we've got here is some investors seeing the data last week, thinking that a Fed is actually at a top now, as well as a lot of central banks, and jumping straight into bond yields. A bit similar to what we're talking about with the mortgages in Europe. You know, if you've been playing the FX divergence in carry trades, earning the difference between the different rates between different countries, if you're now at a top in those rates, the only way, according to what the market thinks, is down from there. So if you're going to lose your rate differential on your FX trades, you might as well lock it in to something a bit more long term, in something like bond yields, where you can jump into a 10-year bond yield, get 4%, 4.9%, and you can sit on that for 10 years. If rates come down in the US to 3%, if inflation is coming down as well, you're not inflating away your profits, so you're getting actual real yields in the money as well. You're potentially earning more sitting on a bond than you would in a currency, whereas the Fed rates might be down to 3.5%, 2% neutral rate, you're earning 4% in a bond. So for some investors, just that 2% difference in investments is enough to get a lot of money flowing. Now, that's what a lot of people are surmising from this move, as am I. Obviously, we need to see that borne out further on. Does it mean we're going to get a complete collapse in yields as everyone piles in? Probably not, because I still suspect central banks are not going to let conditions ease too much, because that's the other side of falling yields. It's loosening financial conditions, and that's not what central banks want to see. So I'm expecting a pushback from central banks at their next meetings. The Fed are in blackout, I believe, or or should be in blackout this week or this Saturday. So we're not likely to hear too much from Fed members. But I expect when we get to the meeting, they may indicate that they're close to a pause, but they will also push back that rates are going to be coming down anytime soon. And that effect will probably keep yields supported thereafter. Just a bit, some geopolitical news from the US, and the Biden administration has forgiven 39 billion in student debts for 804,000 borrowers. That news came out on Friday. So the wiping off of debts, they were pushing to write off student debts for all of them, some 3.7 million student debt holders, but they got held up in the halls of power over there. But they managed to get through 804,000 borrowers, and say 39 billion. If that does become widespread, that might have an effect of keeping the consumer supported, because all of a sudden you may be paying off $200, $300, $400 a month for your student debt, and now you're not. So that gives you the extra beans in the pocket with which to spend with, and we know the Yanks like spending. Right, just coming over to what's going on this week, and we've got some decent data coming out. Kicking off this afternoon, Empire Manufacturing, the first manufacturing data for the month, the new month of July. We know manufacturing has been in a slump for the last few months, so it remains to be seen what happens here. We're expecting this one to come in at minus 4.3 points versus plus 6.6 points prior. Now, this Empire one, I often use it as a bit of an indicator for how the new month's going to go, but it has been very up and down of late. So I'm not going to pay too much attention to it in terms of that. Later on this week, on Thursday, we get the Philly Fed, so the next regional number of manufacturing. This is the second number of that. Maybe putting them both together will give us an indication of what's going on in manufacturing this month. Big number tomorrow is US retail sales. We're going to get a look at what the consumer is really thinking. There has been a bit of commentary coming out about the big, massive drawdown in savings in the US, something that built up significantly over COVID. It's not a good sign if savings are drawn down very quickly. It suggests there's problems on the floor, on the ground, because if people are struggling to make ends meet, they dip into the bank accounts instead of just using their normal pay to get through. So this is a bit of a puzzle that needs unraveling. We may get to see that in retail sales. If it's a significant drop in retail sales, then you can expect further washout of Fed hike expectations, yields lower, the dollar lower. So it's going to be a big number tomorrow. And we also start getting some housing data as well. Keep an eye on that one. Wednesday, probably the big number is going to be UK CPI. As mentioned, we have seen rate expectations being wiped down from a lot of banks, the BOE included. Peak rate of 6.75 was being bandied around a couple of weeks ago. Now we're down to 6.5%, maybe even a little less than that. So this number is going to be very important for what the Bank of England does. I'm still of the opinion, I think this might be a bit sticky. The market is expecting a drop in CPI, and we're expecting headline CPI to drop to 8.2 from 8.7. And in the core number, which I'm just looking at now, we are expecting a coming unchanged at 7.1%. That's going to be the main number. I think it's 50-50 whether this goes up or down. I would side with the possibility more. I'll probably go 60-40 that it goes up rather than comes down, or we get another move where headline comes down but core goes up or stays unchanged. I think if we get hot CPI numbers, we're going to see maybe one final blast of rate expectations running to the extreme. So I wouldn't be surprised to see those 6.5s going back to 6.75s as expectations for the bank rate, Bank of England rate. Trading wise, I'm coming around to the conclusion that maybe we have seen the top for those rate expectations. I've been saying for the last couple of weeks that I'm getting itchy on shorting the pound because I think rate expectations are getting too far extreme. So what will be important on data like the CPI tomorrow is what the pound does. Sorry, on Wednesday is what the pound does. If we get data that potentially has the means to ramp up those expectations again, to send the pound higher, I'm going to be watching. If we are, say, still around this level or a bit below, we get strong numbers, we can't break highs or lows in other pairs, then that's going to tell me we're pretty much priced for those expectations. And for me, they'll still be very extreme. I can only really see downside for the quid from there on. Now, the data may still surprise, so I'm going to be picky in my pairs. I'm already long euro sterling down here from last week into the 85s. This was a technical area that I wanted to have a crack at anyway. But considering we've had a decent bounce since that low and we've had a change in those rate expectations, I'm beginning to think this might become a bit more of a solid area. So if we get hot inflation from the UK and we come back down and we can't get through it again, I'm going to consider adding back into my longs and holding them for a prolonged period, because I think we're going to see the pound getting sold off thereafter. And I wouldn't be surprised if we're heading back up to 87s, 88s, maybe even 90s again. It's obviously going to depend what happens with the ECB, so I don't expect it to be a straight line trade. But I'm expecting UK inflation, particularly from August, to maybe start showing some real legs south. And if we get that, that's going to slam all those expectations of 6.5%, 6.75%. They're all going to get drawn down, and perhaps we get a significant move down in the pound as well. So that's the basis for this trade. But as I say, going to be watching that 85 handle if we get some strong data. If we can't break it, that's going to give me the conviction to stay in longs, and that level is going to be super supportive. Right, that's all I've got on the headline front anyway, but just coming back and looking at what else we've got this week. As you can see on Wednesday, housing starts and permits, so we get to see what happens further in the housing market. On Thursday, we get Aussie jobs report, which could be significant. A lot of the market thinking the RBA is now firmly in pause, so we might get a little bit of trading around that. If we're in a situation where a lot of the market is on pause for a lot of central banks, this type of data isn't really going to swing that anymore. So anything that looks hawkish is likely to get sold into. We're going to really need to see some hot data on all aspects of sectors in economies. A bit like what we're getting in the US at the moment outside of manufacturing. We've got strong services, strong jobs, strong consumer sentiment as seen Friday. The only way central banks are going to start hiking again is if inflation really starts rising again significantly, or if economies really heat up, because that will bring inflation with it down the line. So things like jobs, they're going to be important, but with the market heavily thinking that the RBA is in pause, you get a strong number here that gets sold into in terms of rate expectations. As mentioned, we got the Philly Fed as well on Thursday. Eurozone consumer confidence flash numbers on Thursday as well. Maybe we'll see that improving. And on Friday, we get Japan CPI, which is going to be potentially very important ahead of next week's BOJ announcement. So that's going to be another closely watched number there. UK retail sales, again, a different look at the UK economy. We all know what inflation's doing by then. What's the consumer doing by then? Canadian retail sales as well in the afternoon, and zip all from the US. So a moderately busy week this week data-wise. Lots of stuff for us to keep us entertained anyway. Right, so let's have a look a bit further at prices. And let's see if you've got you folks have got anything you want to look at in particular. Let's go through. So Mike, you're going to be short at 139 and watching for retail sales this week. Yeah, as mentioned, I think that is our mark at the moment on the top side, 139. You know, I was looking at this on the way down. I said it was a bit messy. You know, we've had touches of 139s. We've had these little breaks under. It didn't do much when we came through it on the way down. Such was the power of the move lower. But this is a lesson in that sometimes levels mean nothing in one sense, and then 5 minutes later they're back to meaning something. So as you can see, here we are, having just had a little test down near the low 138s, and that for now looks like it's holding. We had a little bit of a bounce off there. So the levels become the levels again, even after you get the breaks. So good luck with your shorts there, Mike. Be careful if we get too many tests on here. And if we get tests on here and the dips look pretty shallow, that would potentially set us up for a break. So it's all about the price action in how you trade it between those levels up there. Simon, OPEX and earning next week is big data yet. You're right, we do get further earnings this week. We're going to get a sense of how the economies are going, at least from a firm perspective. Again, I think we've got to look for different sectors. I think anything that's consumer-led is going to be important. If we get good reports from those, but remember it is quarterly data, so it is a look back at what's happened, not at what may be happening. And we know there's probably not any significant worries over the past 3 months, but look for that forward guidance in these earnings reports. See if there's anyone worrying about what the market looks like moving forward, because that could counter any good earnings. You know, if you get someone like Walmart coming out saying, "Yep, we've had a strong second quarter, but we've drawn down inventories because we think the next quarter is going to suck," you know, that's what the market's going to look at and trade more so than the better earnings. It wants to know what's coming, not what has been. Now looking at cable, and we've had a little pullback off the highs. Now I was making this point in the chat room this morning. You know, I put in a pretty short-term fib coming in from May. This is just one part of the rally that has gone on since September. So this is just taking one portion of the rally, because there's no point at the moment. There's no point sticking a fib from top to bottom here, because that comes in probably somewhere around the 120 area after 38.2. So, you know, miles away from even looking at breaking this trend. But taking you can take each step. You can take a fib from there, which will come in pretty low as well. I like looking at the steps for different parts of the trend, just to see if they're breaking down. So looking just at this shorter term move, this leg up that we got back in May, you can see we're still significantly far away from the 38.2 fib. So we're nowhere near turning this around yet. Now, we haven't had a decent pullback for quite a while. You know, as you can see in this part of the trend, we had a bit of a pullback. You know, 300-400 pips. That's a decent refreshing of the trend. Same here, a bit of a refresh, keeps the levels going, keeps the trend going. So we haven't had a decent pullback yet in this period. So it could be that we're seeing one coming. 130 is going to be the number to watch initially on any, if we do get this move continuing. Again, didn't do an awful lot on the way up, held up for a while before the break, but on the way back down, this is the type of level I'd be expecting to show up as support if we're going to maintain this trend. Further on down from that, the main level 128.50 and into this fib here 128.24, which will put this leg of the wider trend to the test there. So if we start breaking levels like that, then you can say perhaps something is breaking. Then we look at the wider fibs, the bigger trend, and see what's happening there. But even this move down, as you can see, it looks like nothing. It looks like just a little bit of a blow off the top. for now. But keep an eye on it in case it does come down. Again, what's going to be significant is how we get on back at these highs. If we come up to these highs and hold them again, that's going to suggest we've got at least a short-term top in place. Then it gives you something to lean on if you want to try shorts. Could be a bit similar to what you had here, where you hit resistance, resistance, resistance. Doesn't mean it's going to go down, but it just gives you, it lets you know that something's happening here, and then you get a break, and then you get a break. So just look for the price action to develop, much like we were talking about dollar yen last week and trying to catch knives. Look for the areas that show you there is something going on here and the price isn't going past it for now. If we do break through there, we've still got this 131.70 area, which I know a lot of the ForexAnalytix squad have got their eyes on. So what I would say though is, because we're pulling up around this 131.40s 50s area, if that's where we're parking the bus ahead of this, if we break here, we might sail through this 131.70 level, because it's a bit close to it. If there's any stops in here, it might carry us on through. So just be careful if you do get a move up. If you're waiting for this 131.70 level, just have a bit of caution. Watch the price action on this break here. Looking at some of the other pairs, Aussie dollar continues to show its rejection from up at the 69 level. This might be a pretty significant double top coming in now. We've come down to the big figure 68. We're holding that for now. Again, this was a level that had prior action, potentially a big level on the way up. We got close, it held for a bit, a proverbial 5 minutes, then we blasted through. This might now become something on the way back down, as it looks like it's already doing. So the 68 handle is holding for now. So if you're looking to buy the dip, this is your risk area here, 68s. Under 67, 90, 80, you're potentially wrong. So if you're trying for longs down here, you know where your stop level should be. You don't need to risk a lot. If you get a bounce, you know where your resistance level is, and you know where you need to potentially take some profits on the way to. Mike, you're thinking about getting on cable around 130.50. Well, good luck to you, mate. You may get that in the next few minutes. You never know with cable. Looking at some of the other pairs as well, dollar mex, that's continuing to make new lows. So this break here has proved very significant so far. We're stepping down in where resistance is coming in. We're finding, or starting to find, resistance against the broken level. So look at these recent highs as potentially becoming resistance points. This is getting a double whammy, because it's obviously been a big carry trade, and it's not one that has shown any signs of giving up just yet, but also the weaker dollar is also helping it low as well. So this is what I was mentioning about when you see a price stop. We've had a big strong trend, then we had a period, you know, pretty much all of June into July where we couldn't get through this area. Bounces were weak, bounces to the next resistance point held. This is a bit like what I've just shown in dollar yen, with a break to 137, bouncing back to 139. So a similar price pattern here, where we had support, we've had resistance where it should be, then you get the break and off it goes. You know, you can apply this sort of price action to any asset you like. Doesn't matter. You don't even need lines to do it. Just apply that, learn how price action works. Then you don't need to guess whether it's going up or going down. You know, if it breaks here, it's going down. You know, if it breaks here, it's going up. So here we have, this time it's broken down, and these little steps here show you that sellers are not going to let it gain significantly before they hit those rallies. So rally selling mode is in full effect here. Just take a look at the wider picture. My next level is down to this support, which goes all the way back to 2015. So it's down at 16.36, that sort of area. If you break under there, there's a bit of open room to drop a bit further down from there. The only thing I would say is that this was a pretty short-term area a long time ago. So although I flag it on my charts, I'll want to see it. I won't blindly trade those sort of levels. When you get levels like this one here, where it's a decent level over a decent period of time, those are the ones I like to trade, because they're the ones that have got good history behind them. This one hasn't got that greater history behind it. It was a period, it was a level, but I wouldn't treat it as strongly as something like those ones up there. As mentioned, we were looking at oil, and it has run into trouble. And look at that, right into the 200 daily moving average. So we've got the 100 moving average just below, which it's had a bit of an on-off relationship recently. But if you're looking for a support point, that comes in just above my old pivot zone down here, 72, 73s. So seeing a bit of a pullback in oil at the moment. If you're looking again, catch the knife, pick your levels. This is one area you potentially be looking at to get into longs if we're going to continue with this move higher. It's faded out pretty much bang in the middle of this zone that I've had on my chart for a while. 82.50 is still for me the big level above, and a bit of an intermediate level around 80.50. So if we are going to bounce off of here, we might put in a move to those areas, check the fundamentals. I still don't see why oil should rally significantly given manufacturing is in the doldrums around the globe. But who am I to be an oil trader and decide what the market wants to do? Looking at gold as well, and it's gone a bit quiet now. We've had a lot of dollar moves, and some people were asking on the Face show last week, why isn't gold doing more considering what the dollar's doing? It tends to tell you that the market isn't really using gold for anything in terms of what other markets are doing. It's also a reminder to say, don't trade one asset through what's happening in another asset. It's like trading the Canadian dollar and oil. If you're looking too much at oil to find out what the CAD is going to do, then trade oil. Don't trade the CAD. You don't want to put too much attention into what something else is doing when you're trying to trade another asset. Trade the asset on what the asset is doing. And what the asset is doing is gold is not getting through 1960s. That's all you need to know. Doesn't matter what the dollar's doing. Doesn't matter what anything else is doing. If it's not getting through 1960s, it's not getting through 1960s, irrespective of those. We are finding a bit of support around 1950s, but I don't see that as anything really significant. A bit of an on-off support and resistance area. The big level is 1930s. So that to me is where you set your trading boundaries down into 1930s, 35s, 1960s, 65. If you get a move outside of those two areas, then you're going to get a continuation move likely. So that's the way you trade it. And as I say, forget about what's going on elsewhere if it's not making sense. I don't know if you guys and girls got anything you want to talk about in particular. If not, then I may have a look at just one other pair, Euro CAD. Got the big break at the 46.5 level, found the support, and it is kicking on still. So I'm going to need to probably refresh my lines. But the next resistance area around 149s for me. But otherwise, we could maybe get in a move up to these highs again. That might be a bit juicy to look at for shorts. If we find a bit of resistance coming into 151s again, it might be worth having a look at. Because again, you don't need to have a very high risk trade, through 151, probably 20, 30, this is a break. You may even want to look at that as a stop reverse into a long if you get a break of that area. But a long way to go just yet, but we've come quite a way already in a short space of time, particularly this month, coming from the 144s, already up near the 149. So it is possible that we get a move up here. I know, look, you guys are looking at Euro Aussie as well. Still finding life tough up here into 164s, 165s. But we have been coming back quite quickly to this level. We had this move up, move down. We've come up quite quickly. So potentially we are on for a bit of a break again, a bit like Euro CAD. So keep an eye on that. If you get above, you know, this high here, 165.5, then you're probably off and running. And maybe we're up to 167s not long after. Oh, excuse me, the old voice is going again. It's only Monday. Right, anyway, I'm going to call that a session for a Monday. Let you guys and girls get back to your charts and start digging into your own stuff. Maybe we'll be joined by Stellis on the beach if he can grace us with his presence a bit later this week. He's enjoying himself in a nice villa with a nice pool, and we're all jealous. Anyway, take care today. Keep an eye on that data coming up from the manufacturing New York Fed later on, and obviously the big data coming the rest of the week, tomorrow, US retail sales and the like. Have a great week, everyone. We shall see you tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.